Our next presentation this evening is from a special person who has been around the world many times over. He is the chairman of David Hale Global Economics. I'd like to introduce tonight's keynote speaker, Mr. David Hale.
Thank you very much. It's a great pleasure to be here this evening to see old friends and to take part in this conference. I have, over the years, attended this conference to meet with a wide range of small mining companies from Canada, the U.S., and Australia. I also feel very blessed. I'm following two companies whose share prices have gone up this year. And I think it's a truly great achievement, given the market conditions we've had since the summer of 2008. My assignment is to give you a global economic overview and to address the investment challenges and opportunities we'll be confronting a year ahead. Needless to say, we've had in the last several weeks very tumultuous and very turbulent markets. We've had a crisis festering in the U.S. financial system for almost 2 years, linked to subprime mortgages that would have produced over time very large losses for American financial institutions and European and Canadian financial institutions that were investors in these securities. But the crisis became more acute, became more devastating, because it also set the stage for the failure of some major financial institutions, in particular, 8 weeks ago, Lehman Brothers. There's no doubt that when Hank Paulson, the Treasury Secretary, allowed Lehman to go bankrupt, he unleashed a global financial panic. The interbank lending rates skyrocketed, the commercial paper market froze, one money market fund had big losses, which produced a crisis for the whole money market fund industry, and we had weeks in the last month when the stock market fell 20%. So the Lehman bankruptcy was very much the event that produced the turbulence we've had here in the last 8 weeks. But the roots of this crisis go back a couple of years. And they go back to the American real estate boom that occurred in the years 2001 and 2006. In that period, the average house price increase in America was about 70%. And on the two coasts, places like California, Florida, it was 150 or 200%. So we had a very frothy market. And this frothy market helped to spawn a whole new mortgage product called subprime loans. These were loans targeted on low-income people, unemployed people, people of very marginal means who would not have qualified for a home mortgage 10, 15, or 20 years ago. And there was a great competition in California and Florida and elsewhere to make these loans. And the banks that made these loans weren't concerned about the asset quality because they didn't keep the loans. They sold them to Wall Street, to Goldman Sachs, Bear Stearns, Merrill Lynch, who then securitized them, turned them into bond-like instruments, collateralized debt obligations, and sold them all over the world. These securities were sold to towns in the Arctic Circle in Norway, country towns in New South Wales, banks in China, banks in the Philippines. They were sold everywhere. It was truly a global phenomenon. And the result was we had, by 2006, about $1.3 trillion of these securities outstanding. And then, in 2006, because of Federal Reserve tightening, a change in monetary policy, the housing market began to slow down. We no longer had 15 and 20% house price gains. The market cooled off. And in 2007, house prices began to erode, very gradually at first, but there was still a change in direction for the first time in quite some time. And this set the stage for an increase in the default rate on these mortgages, because many people had mortgages they couldn't afford. But they were able, every 9 months or 12 months, to refinance with a new bank and therefore prolong their ownership of the property. They also thought there was no danger of default because house prices always go up. And if house prices are going up 10, 15% per annum, the fact is you can't make a bad real estate loan. But anyway, over the course of 2007, we discovered that we had a major problem. Last June, a couple of big hedge funds at Bear Stearns that were heavily invested in these subprime securities went bankrupt. That was a real warning to Wall Street that we had a big problem developing. And in the weeks that followed, the value of these securities crumbled very sharply, and many large banks discovered in the autumn of 2007 they would have large losses. At that point, Citibank, Merrill Lynch, UBS in Switzerland, and others had to acknowledge they'd be confronting in the new year some potentially large loan losses. So the situation continued to unfold. In March of this year, Bear Stearns got in trouble because they had been a big mortgage securitizer, and they went bust. Had to be rescued over the weekend by JP Morgan, with the Federal Reserve Bank providing a $30 billion credit to help facilitate the transaction. The Federal Reserve at that point also opened its discount window to all investment banks all securities companies, a policy it had not followed really for many, many years. It was thought at the time that when the Federal Reserve did this, it would guarantee that firms like Lehman could not go bankrupt. But Lehman had a big, big real estate portfolio, and the value of those assets was still deteriorating. So finally, by September of this year, Lehman reached a point where it could not refinance itself, had to confront these bad assets, and that set the stage for the firm to declare itself insolvent. So where do we go from here? The IMF estimated back in April that the losses on U.S. residential and commercial real estate in the year ahead would be $965 billion. 6 weeks ago, in mid-October, the IMF revised up that estimate to $1.4 trillion. So we will be writing off a lot of these loans in the year ahead. We've already written off about $750 billion over the last 12 months, but we've got $700 billion more to go. And now we're in a recession, so obviously when you're in recession, you have the risk that things will get worse, and you'll have other forms of credit default, not just on mortgages, but on credit card loans and business loans as well. And the very bad news is we are in recession. This recession probably began in August. The U.S. economy was being sustained in the first half of this year by an export boom. Because of robust growth in the rest of the world and the very cheap dollar we had after a long period of devaluation, American goods were very, very competitive. And the growth rate of exports in the first half of this year was 18%. That kept the manufacturing sector pretty much intact. We also had in the spring and early summer tax rebates, $110 billion. That also propped up consumption. But by the late summer, the benefits of these two factors were eroding. We also had in July the gasoline price of $4.20 a gallon, and that was a real squeeze on U.S. households, a real squeeze on U.S. consumption, and that set the stage for a decline in consumption in July and August, which then intensified here in the autumn. And now we have as a factor constraining consumption not just gasoline. On the contrary, gasoline prices are now collapsing, but we have a credit crunch. Credit is now far less available in America than it was a year ago or 2 years ago. Last week, GMAC, the big auto finance company, announced that will only make car loans now to people with credit scores over 700. This is devastating for GM. 2/3 of the people who applied for loans at GMAC in the last year had credit scores of 600 to 700. So when you basically have this high a credit score, you're disqualifying half the population from a car loan. We also have the problem in GM that people who have high credit scores, 800 or 900, tend to buy foreign cars. So GM's new credit rules have struck directly at its core market of lower middle income Americans. So car sales have now collapsed. They're below 11 million at annual rates, numbers we haven't seen in the last 50 years. And there has been a wholesale decline in other forms of retail spending. Monthly, year-on-year sales at Neiman Marcus last month were down 28%. Saks was down 17%. JCPenney was down 13%. This is a very, very severe consumer recession. Now, because of this crisis, there has been, over the last 9 months, a quite dramatic policy response in Washington. And I want to spend the next 2 or 3 minutes reviewing the policy response, because it will set the stage for what happens in the year ahead. The most dramatic policy response has come from the central bank, from the Federal Reserve Board. Over the last year and few months, the Federal Reserve has cut its core lending rate from 5.25% down to 1%. They came down to 2% last April, when they went sideways for 4 months. But in early October, we had a globally coordinated interest rate cut with the US, Canada, Britain, Europe, Switzerland, and Sweden all taking part. And then last week, when the Fed had a meeting in Washington, they cut again from 1.5% down to 1%. And most Wall Street economists think when the Fed meets again in mid-December, they'll go to 50 basis points. It'll be the lowest level of interest rates we've had in this country in the last 60 years. And many people think that in the new year, Ben Bernanke will go possibly all the way to zero. Japan had 6 years of zero interest rates earlier in this decade, but the US has never had zero interest rates. But many people on Wall Street think that is now a very distinct possibility.